Hey everybody, welcome back to Investing with Wesley. In today's episode, I want to talk to you about the yield curve and the bond markets because some interesting things have been happening. So with that being said, let's get into it. Okay, so what is the bond market, what is the yield curve, and what has the interesting things been that have been happening? Well, as you may know, the bond market is the other half of investing. There is the equities and there is the debts. Equities are things like stocks, whereas debts are the bonds. Now, when you invest in equities, you're buying into the company in hopes that it will continue to grow, and you carry much more risk than if you were buying a bond. And that's simply because if that company you're investing in goes bankrupt, whatever assets or whatever money they get from selling off all their assets, they pay their debt holders first before they pay their equity holders. This is one of the main reasons bonds are considered a safer investment than stocks. Now, the easiest way I could describe a bond to you is that you basically become the bank and you issue a loan to either a business or government. You as the bondholder will give them a chunk of money, in a sense financing their operations and their debts, and in return they will pay you a certain amount of interest for a certain amount of time, and then once that time is up, the time of maturity, then they'll give you whatever money you gave them back. So it's a way to earn income because you get your money back, you get your initial investment back, plus a little bit of that interest. Now, there are plenty of different markets when it comes to bonds, but the only one I'm going to be talking about today is the US Treasury bonds, and that's why we're going to get into the yield curve. The yield curve is a chart or a graph that plots the line of interest rates according to the maturity rate. When it comes to charting the yield curve, more often than not, the less time to maturity means the less interest that will be paid out. And the more time to maturity means the more interest has to be paid. And this is simply because bonds like to price in risk, and there's nothing more risky of going into default than waiting 30 plus years for maturity. So because waiting 30 years is considered more risky, they have to entice investors with more interest to be paid out. Whereas only waiting 1 to 5 years is less risky. So rightfully so, they pay less interest. So like I said, in a normal situation, the yield curve looks very similar to an equities or a stock chart that goes up in a parabolic manner. It starts off relatively flat and low, and then as time progresses, it goes up drastically. Now, honestly, although the graph looks like it goes up drastically, you're talking about the federal government's yields and their bonds, which pay little to no interest as is. So when I put the graph on screen, you'll see that the difference in interest rates are very minimal, but nonetheless, they still go up over time. Now, like I said, that's how the yield curve is normally, but the yield curve doesn't act normally all the time. There's a total of 3 different directions that the yield curve can go. The first one is the normal one we just talked about, the standard yield curve. The second one is when the yield curve goes flat. So instead of it going up in that parabolic nature, it remains level and flat. And the yield curve never stays flat for long. Typically, when a yield curve goes flat, it's in the process of changing one direction to another. And that leads us to the third type of curve. The inverse yield curve is when the yield curve flips upside down and the longest term bonds pay less interest than the shortest term bonds. So instead of a parabolic nature going up like the normal one is, it goes the exact opposite way. It starts off high and drops down as time progresses. Now, why would the yield curve go inverse like this? And remember, bonds like to price in and try and predict the future, or at least the investor sentiment that we think the future holds. So if we feel like in the midterm, 1 to 5 years, there's going to be some sort of recession, then a lot of investors will choose to invest their money into bonds at a much shorter time frame, thus collecting a little bit of interest to fight inflation, but still remaining liquid for this recession to buy into the equities when they go on sale. And the reason they would do this in the short term as opposed to the extremely long term, like the 30-year bonds, is because if they're expecting a recession to happen, then they're also expecting the Fed to step in and basically create more inflation. So instead of being trapped into inflation and waiting 30 years to collect your money and your interest, instead they would rather go short term. and all the money going short term will inflate the prices, and all the money not going into long term will cause the long terms to go down, thus giving you that inverse yield curve. Now, I know it sounds silly because pretty much everyone preaches that no one can time the market, no one can predict depressions or recessions, and no one can do it at least for very long. And that is completely true. However, it's a well-known and well-studied fact that whenever the yield curve goes inverse, it triggers a recession or depression. The only trouble is we don't really know exactly when. So although the yield curve going inverse has triggered or predicted every single recession for the past decade and more, the timelines are completely different. Sometimes after the yield curve goes inverse, the recession starts within a couple months. Other times it's within a year and a half. And it also seems to depend on how long the yield curve remains inverse. And that's one of the interesting things that I wanted to mention in this video, is that it is a fairly accurate predictor of recessions. Now, the second thing, and potentially much more interesting thing that I wanted to bring up in today's video, is that we're starting to see the yield curve go inverse right now. Or rather, we see the start of it right now because it really hasn't moved a whole lot. Looking back on that graph I showed you, you see that it is still a normal yield curve. But if you look between the 20-year Treasury maturities and the 30-year Treasury maturities, you'll see that there is an inverse right now. The 30-year Treasuries are paying less interest than the 20-year Treasuries currently are. Now, considering all the other interest rates are going up over time as we expect, why is this one little difference between a 20 and 30-year interest worth it? And this is because typically when the yield curve starts going flat and then proceeds to inverse, you see it first starting with these long-term yields. Think of it like a wave at the ocean. It starts relatively flat, it comes up, and then when it starts to crest and flatten out again, it buckles at the top and goes back down. The same thing is true for the yield curve. It'll often go up in its normal manner and then start at the top and start flattening towards the inverse. Now, why do we see the 20 and 30-year rates go inverse? Well, first, it's how bond prices and yields are calculated. Bond prices and their interest rates have an inverse relation. As bond prices go up, interest rates go down. And if you pay attention, interest rates are going up across the board. And why is that? And that's because a big player is getting out of that bond market, and because they're no longer buying, the demand isn't there, so the prices go down and interest rates go up. Now, who's that big player pulling out of the bond market? Well, it's none other than the Federal Reserve itself. Remember, part of the 2020 coronavirus pandemic crash and the monetary policies that the Federal Reserve put in place, part of it was to buy a bunch of government bonds. Their goal was to buy a bunch of government bonds to force the price to go up and thus the interest rate to stay down. That's why we've had such low interest for as long as we have. But because they decided to taper off and pull out of those markets, now we're starting to see the prices go back down and the interest rates go back up. And that's what you're currently seeing in the bond market right now. On the long-term maturity side is the Federal Reserve pulling out and causing the interest rates to go up. And on the short-term side of the yield curve, you have smart money. Now, the smart money knows that our economy is not fixed and still needs to be helped. But due to inflation, the Federal Reserve can no longer help and they have to raise interest rates. Because of this, smart money knows there's probably going to be another recession, so they're flocking to these short-term bonds to collect that interest rate and keep their investment relatively liquid. Because of this priced-in risk that investors have, that's causing the short-term rates to go up. And because a big player, the Federal Reserve, is leaving the long-term side of the bond market, that's also causing interest rates to go up. So the entire yield curve itself is going up. Now, that doesn't spell out inverse. What does spell an inverse yield curve is that if the short-term fear remains by the time the Federal Reserve is done tapering, then the yields on the long term will stop going up, but the yields on the short term will continue to go up if the fear is still there, causing it eventually to go inverse. Now, what does all this mean? What does it mean for you, and how could you prepare? Well, honestly, right now, all this means is that interest rates across the board are going up, so you can prepare knowing that borrowing across the board for you, the consumer, is going to go up in price due to the increase in interest rates. But you could also prepare by paying more attention to this yield curve as we start to see it flatten out and then go inverse, so that you could be amply prepared to stock up some cash and be ready for the next recession. I hope you got value in this video. If you did, please remember to like and subscribe, as it really helps this channel get out there and grow. I think currently my statistics are something like only 5% of you are actually subscribed that watch this channel. So if you don't mind, if you know you're not subscribed, go ahead and hit that subscribe button. But either way though, the choice is yours, and I'll see you in the next episode.